Hi, everybody. This is Dennis Wilborn, founder of Active Trend Trading. Thank you for taking the time to watch this free video that we do every week. It is a video where we cover the markets. We also have oftentimes have some trades that we might be setting up that you might want to take. But I want to ask you, before you leave the page, as you watch the video, just give us a real quick thumbs up and share the content with somebody else. Leave us a comment. We'd really appreciate that. So aloha, God bless, and mahalo. One of the areas that I really would like to focus on, especially with folks who are new and or even longtime traders, so oftentimes it's something about our human nature. We always, for whatever reason, we oftentimes can't say no to doing something, whether you do volunteer work, whether you are raising children, whatever. There's something in our nature that says, well, you can't say no to things. And kind of learning how to say no in trading is a very important thing. One of the areas where people can say no to trading that would help improve their trading is establishing a list of stocks and then saying no to adding anything to it. And what I mean, will you miss out on stuff? Well, that's the big fear. I once was coaching a lady who was a psychologist or a psychiatrist, one of the two, who she goes, Dennis, I'm so busy with my clients and my patients and all that kind of stuff, and I'm really freezing on pulling the trigger on trades and that type of thing. And so as I worked through her issues, one of the things that came I go, well, I asked her, I said, well, Jan, and that wasn't really her name, but we'll use that. I said, Jan, how many stocks are you currently trying to watch? And she goes, well, my watch list is about 75 stocks. I go, well, gosh, no wonder you're struggling. Part of the thing is you're just watching too many things and it doesn't fit into your busy schedule with your clients and your family and all the other things that are sharing time with what you're doing trading. And I go, what I want you to do over the next 90 days is cut it down to where you're only watching 10 stocks per at a time. And she flat told me, no, I can't do that. And I go, well, Jan, why can't you do that? She goes, if I do that, I'm afraid, watch her choice of words. Now, this is a clinical psychologist, right? I'm afraid that I'll miss something or that one of the stocks that I'm not watching will have a big move and I'll miss out. And so I tried to reason with her. I said, well, okay, that's all well and good, but dadgummit, you're missing out now because you're trying to watch too much. And she goes, oh, yeah. And so it caused a real dilemma for her, but she was unwilling, even though it meant increased profitability, she was unwilling to reduce the number of entities that she was going to be watching. So I guess the moral of the story is that sometimes, if a clinical psychologist who's trained in having a healthy trading psychology, or healthy psychology in themselves, is challenged with that kind of stuff, then us mere mortals, of course, we need to be doubly alert to watch for a situation like that. So it's one of those simple rules: trade less, profit more. What do I mean by that? Again, a reminder that all materials presented are for training purposes. Traders should always pay for trade any new method prior to the risk of their own personal capital. Past performance is not a promise or a guarantee of future performance. For this session, I really believe the quality of belief determines the quality of our action. Faulty beliefs lead to faulty actions. And so I encourage folks all the time, challenge your beliefs. Are your beliefs based on, known truth? Or is it based on what you think is the truth that somebody else told you was the truth? But have you researched yourself to make sure it is the truth? And so, if only we really understood some of the followings. One, there are only four outcomes from every trade. We either a small loss, 2, a small gain, 3, a large gain, or number 4, a large loss. Our objective is by using a solid rule-based mechanical system will eliminate most of the risk from number 4. In other words, if we basically accept that I'm only going to accept 1, 2, and 3, okay, we're not going to have to worry about our accounts getting hammered to the downside because we're following our rules. Like if you have a 5% stop loss rule and your price is getting close to that 5% stop loss, and you go, I know it's going to turn around, so you take the stop loss off, and you wind up going down another 5% so that your total loss is 10%. You just lost 5%, which is unnecessary, which was a self-inflicted wound that if you put enough of those together, you will destroy an account. So the fact of the matter is rules are there for a reason, for protection, and to protect capital. So just understand that. And so in the way again, what we want to do is manage our risk. I was talking with a friend of mine who was visiting a couple of months ago, and he was interested in what we're doing with active trend trading. And he says, yeah, I'm really interested in finding out about that. And so he then shared it with his wife and said, hey, and she was here with him. And he says, yeah, I'm really going to, want to get in with Dennis on doing this. And his wife, the first thing in her mouth was, is there any risk? Now, you got to realize some folks are really risk adverse. And I explained to her, I said, yes, but we control our risk and we limit our risk, which is exactly what you do when you follow your rules. And so moving along. If only we really understood, 1, eliminating variables helps to boost consistency. If you've ever solved a mathematical problem or an engineering problem or a financial problem with multiple variables, you know that the more variables that are in the stew, the harder the equation is to solve. So what can we do to solve or eliminate variables when we're trading? Well, 1, make trading decisions that will clarify and simplify. What is one way that we can do this? Well, 1, plan your trades when the market's closed. Plan your trades when the market's closed. If you're doing all your own trades. Why is that? When the market's open and the price is going like this and it's going up and down and all around and all that kind of stuff, that creates an atmosphere where emotions can kick in and basically dictate what you're doing. The old adage that when we become emotional, our IQ goes down and our decision making also gets worse is absolutely true. When it comes to money, if we're making our decisions when there's a lot of noise going on in our life, we will most likely make a poor decision and lose money. 1, a few tested rules will keep you out of trouble. With the active trend trading system, we have 4 rules to enter, 6 rules to exit. It's just that simple. As long as we stay inside this structure, We basically are eliminating variables. We're eliminating variables. Apply the process over and over again. It's that old wash, rinse, spin, and then repeat cycles and all that kind of stuff. And I hope you guys can't hear the neighbor's dog who's barking up a storm. He hears me talking and thinks that I'm talking to him. Anyway, this is the routine. This is the routine. Develop a routine that is consistently, I do the same thing. If you have 15 minutes to spend every day, identify the amount of time you have to spend every day to review the markets. If it's 15 minutes, then have, and you want to know, okay, how can I most effectively review the market in 15 minutes a day? Hey, drop me an email. I'll help you solve that puzzle. Give me a call, and we'll help you get your routine going. One of the ways to help with that routine is limit candidates to stocks and ETFs that are proven performers. And so that was one of the things that, remember the psychologist that I was working with, is she really wasn't doing this. She wasn't limiting her candidates to proven performance. Her universe of potential stocks was huge, and she didn't have time enough to mush it all down into these are proven performers. I can count on them. So I'm going to give you a couple of tips on how to do that moving forward, and then see. So trade less, control more. So one of the ways we do that with active trading, of course, is we trade the Magnificent 7 ETFs, and then 3 to 5 growth stocks we keep our eyeball on. Sometimes it's a little bit more than that. Sometimes it isn't. It depends on kind of the time of year. Like if we're in earnings season, I'll probably be looking at, I'll be taking a brief look at more stocks in this, because I would like to have, a couple of stocks to trade every week for earnings season. I don't try to trade them all. Okay, how many? Think of yourself as kind of like a vessel, or a jar. And a jar only has so much capacity. You as a jar have a capacity to handle maybe 2 to 5 trades or 2 to 5 positions per week, or that are open at any one time. So with that in mind, basically structure yourself to, okay, if my capacity is 2, then I don't entertain 3. Now I can go and I can practice, but if I'm open in 2 positions, I can just be very, happy and say, okay, I'm content. I have met my quota. Now I'm waiting for the market to provide me either one of those 3 outcomes we talked about earlier. So don't trade them all. So how many should we trade? As we identified, okay, if I'm doing a leveraged index ETFs, I want to choose 1 or 2. I don't have to trade all of them, because guess what? Most of the time, your SPYs, your Qs, your IWM are in a lot of ways following the same pattern. Now, are they going to have differences in their amount of runs? You betcha. And that's why a lot of times I will hone in on the ones that tend to move more, which is the Russell and the NASDAQ. And so I'll kind of try to focus there. But I occasionally take a look at the SPYs. Sometimes the SPY is leading. But I will not trade all 3 of them, because that, what diversity is there in that? Not a whole lot. So that's that. Secondly, okay, I look at industry commodity / leveraged ETFs. Choose 2 to 3. Okay, if I'm following 5, biotech, financial, and I kind of don't follow financials anymore. Why? Because financials and the S&P are basically follow a similar pattern. So if I'm trying to trade the financials and the SPYs, well, the financials moves are being captured in the index ETFs themselves. So However, gold, oil exploration are the things that I cover. And I, again, want to choose 2 to 3. So if you're keeping up with the math, that means if I trade 1 of these and 2 of these, that means I'm up to 3 already. So what's your capacity? And then 4, and I have 4 to 5 stock, core stocks. I like Tesla, NVIDIA, Amazon, Palo Alto Networks, Netflix, Team. We take a look at, various of those. How many of those? Choose 2 to 3. And then just wait for the patterns to happen. That's key. If you're making notes to yourself, wait for the patterns to happen. Wait for the one of the 4 entry rules to be triggered, or the 6 exit rules to be triggered to take your action. So which ones? Well, it's going to depend. The ones, okay, here's what I like. The ones you have time for. The ones you have time for. If you don't have a lot of time, cut this down even more, where you can do 1 to 4. If I was really, really, really limited on time, I think what I would do is I would focus on 2 different areas. I would focus here, and I would focus here. I would probably either choose the biotechs, or I kind of like the oil exploration. One of those 2, I like and basically I would, if I had to limit it again to 1 or 2, I would choose IWM and I would choose biotech. Now that suits me, okay, and I would just hone in on them. I would eliminate watching any of these. Why? Anybody have a guess why I would eliminate watching the stocks? Okay. Why would I eliminate watching the stocks? Hello. Diversification? No. Mark, not diversification. By Barbara Rocco? Better return? No, not necessarily. What am I trying? Here, I'll give you a hint. What am I trying to control? Starts with a V. I'm trying to control variables. If I eliminate watching the stocks, I've eliminated 2 variables. One, the variables of the stock themselves, but also the variables of earnings. What takes place over earnings? Because earnings doesn't impact either of these first 2 entities up here. And so I don't have to take that in consideration. It's one less thing I have to be concerned with or worry about. Now, will news events drive these 2 up here? You betcha. No control over that. But I can choose not to follow a stock because it helps me eliminate a variable. So, okay, which ones? We talked about that. So let's get in and let's take a look at an example. And this is JNUG. What JNUG is the 3-time leverage ETF of the gold miners. This is 2017 data. And what I want to bring across with this is you know, it has, as you can see, as I take a look at this, it has a very nice looking patterns to its charts. There's a lot of things, a lot of places you could be trading this. It was falling down here. But with the JNUG, I'm only going to trade, or with any of these entities that I'm going to be showing you here shortly, this is a bullish, so I'm only going to trade this to the upside. The only way I'm going to trade this is to the upside. Now I can trade if I'm watching the gold miners. So if the gold miners are going up, JNUG is going up, but it's going up at 3 times the rate of the others. So, and then on the flip side of that is JDST, which is a 3-time leverage junior gold miners, but it's the inverse of it. So if I'm watching this, how many times during the year, and I just, you know, as I can see, you've got several really nice opportunities, nice patterns, nice, you know, zigzag type patterns. But what about the potential growth on this as we sit there and we kind of take a look at there? Well, not even taking into consideration from the beginning of the year, this nice move up here, I'm just going to capture a few, not even the best ones, but a few of the moves to the upside. So right here, in the first, this move, 57% in 9 days. That's pretty healthy. 56% in 13 days. That's pretty healthy. 62% in 30 days. That's pretty healthy. And then finally, 61% in 27 days. Why don't you take a look at a couple of different things here? Well, first, if I captured just half of that move, half of that move, half of that move, half of that move, and I compounded across those 4 different moves, $1,000 trading capital would have grown to $2,800 by capturing 1/2 of these 4 moves. Okay, that's just the specific of having a compounding plan in place for the trades you want to take. So over a year period of time. Now, if you increase this up to a larger amount, of course, it's going to make, you know, even your return will, well, your return will be the same, but, you know, you'll grow your account. But that's a pretty healthy chunk. A lot of people search every year for, I got to find something that I will make 100% on. And what we provide through active trend trading is basically we provide the candidates that have the potential to give you a 100% compounded return on a yearly basis. And that's what we drive toward. And even we keep it very conservative, even more conservative than that, because if I'm happy if I can generate 40% per year, that's good. I think our new approach towards strategy 2 of the strategic compounding will actually see this start to improve. But as you can see, a nice move up there. Let me get rid of that. So again, these are, again, capturing just 1/2 of these 4 moves. Were there triggers in place for these moves? Yes, there were. What are some of the other things I want you to take away from this? Take a look at the number of days, the percents run, the number of days. So similar run, 56 days, 57%, 9 days, 56%, 13 days, 62%, 30 days, 61%, 27 days. I hope you'll see a theme going on there that when you get into a trade, if we enter at the proper point, there we can basically be aware of, I want to be taking action somewhere between I want to be taking a look at 9 to 10 days, 9 to 13 days. So let's say 10 days. That's how strong and how much it might move. That was 57%. That's really great. Again, similar type thing up here. And where do I start counting from? I start counting from my swing low up to my swing high. Swing low to swing high for the total move. And again, here, 62%, 30 days. And here again is a link back to some of our timing stochastics that we've talked about. The symmetry of move. Okay. Yeah, I went over 4%, 4 days difference here, but still, this was over a weekend here. I don't know if this counted the weekend here, but it did count the weekend, but 9 days. It depends on how this counted out here. It may have been over 2 weekends, and so forth. It was 13 days. It was capturing all of it. Look at 30 days, 27 days. See the similarity, the symmetry in the move. And so once we start looking at a chart, look for the symmetry and look for it to repeat. And it's a good way to build your targets and also eliminate your variables. So what about to the downside? Well, let's see, what do we got? Oh, well, here's JNUG. Did it repeat? Is it worth going, okay, well, that's 1 year's worth of JNUG, okay. But let's take a look at 2018. 2018 for the gold miners was not as good as 2017. However, how did it do during the 2018 session? Well, again, applying the same characteristic, not trying to capture everything, but trying to capture specific moves. There's one there. There's a nice one there, where we came back and did a retest, and so it would make sense. So 42%, 5 days, 26%, 14 days, 34%, there it is, 9 days. And as again, we're starting to see these somewhere between 5 to 18 days was all the move lasted. And so once I get past 5 days, I want to be starting to look at, hey, maybe it's time to start tightening your stops, protecting your gains, and moving forward from there. So JNUG, respectable moves. I mean, a lot of people would be very happy with that kind of move. Wow, how did it do compounding? Well, your 1,000 grew to 2,000 for the year, and 4 moves capturing 1/2 of them, 100% gain, 100% gain. So not too bad. Now let's take a look at the opposite. If you're not trading JNUG, could you flip over then and trade the inverse of that? Well, here's JDust. Again, 2017. So when JNUG was going up, no, going down, JDust was going up. Again, applying the same criteria of trying to capture 102%, 26 days, 107%, 22 days, 42%, 25 days, and then 30% in 9 days. Again, I'm not trying to show that we're just so diligent we're capturing every trade. But if I can average just catching, like 4 of the trades or 3 of the trades on a yearly basis, that's pretty rock solid. So as we can say, JDust. And so what did that turn out to be? Well, $1,000 turned into $3,200, capturing 1/2 of these moves on these 4 moves, gaining 222%. That's something that should capture people's attention and go, okay. And the question each of us traders have to do is, am I willing to be patient and wait for the trophies to present themselves, the trophy trades to present themselves, just like if I was out there hunting trophy deer or trying to, anyway. So this is the move up with that. Now, what about 2018? How did it do in 2018? Well, as we can see, 2018, a lot of zigzagging all over the place. However, 69%, 17 days. 19%, 13 days. Another. I didn't try to capture all of this, although I could have, but I just went from this low to this high, and then it reversed back down. I did not try to capture this to make it sound really, really great. but the move from 45 up to 85 is well over 100%. So I picked up this one over here, 38%, 8 days. And so for the inverse in 2018 would have been worth trading. Yeah, almost 100% return, 1,000 into 1966. Again, just keep it holding. And the other thing about it is other benefit of short holding periods, 17 days, 13 days, 14 days, 8 days, is that when you basically are not in the trade, you basically have eliminated a lot of your risk off your portfolio because you're in cash. Then you wait, and you repeat the cycle again and again and again. And so that's one of the things that's one of the reasons why I was attracted to the inverses and the 3-time leverage, inverse and non-inverse for JDUS, the gold miners. Any questions so far, guys? Because the next chart's going to be a lot of fun. Okay. The next trade is Palo Alto Networks. Again, going back to 2018, let's take a look at 2018 for Palo Alto Networks. Now, one of the things when we're taking a look at stocks, up until this time, we were looking at the index in the sector ETFs for the gold miner sector. But if we find a strong stock, that one of the things to look at when you're looking at a chart, say, oh, look, this chart puts in really nice patterns. And it's the patterns that allow us to trade it. Do the patterns follow a pattern? Or basically, what I'm trying to say there is within technical analysis or traditional technical analysis, there's certain parameters of a pattern that you would expect to kick in. One is, on pullbacks, we would expect to drop, pull back, and then the next drop would be approximately equal to the previous drop, approximately equal to that. And so that's a couple of things we take a look at. Because what does that tell us? It tells us that the people and the institutions that are trading that stock are basically following good basic psychology, trader psychology for trading the stock. In other words, they're following a pattern, which the pattern says, oh, okay, if I get a pullback of about a third to 2/3, that's where I want to start buying again. And each one of these is following that. Is it respecting the moving averages? Yes, it is. So let's take a hard look at, okay, how did Palo Alto Networks done? And I've included here a couple of different things. One, what the percent move is, the number of days in the move, and how many dollars from low to high that were encompassed by the move. So here's one move, 29%, 30 days. Excellent. Another move, 8 days, 12%, $21. Another move, almost 14%, 15 days, $28. And this is the reason I'm showing you this, and you'll see it shortly. And now, what about to the downside? Okay, it dropped almost 18% over 17 days, dropped $38. Oh, look at this, 12 days, 16.74, dropped $32 approximately. Not quite exact, equals, but in the ballpark of similarity is what we wanted to take a look at. So let's assume that I shorted these particular trades, but again, the same rules of picking up only half of the move. How would we have done? Well, our $1,000 trading capital would have grown to $1,535 by picking up 1/2 of these 5 moves. A gain of 53%. So nothing, not a not a bad trade. 53% for a year's worth of work is excellent. However, this is where some people might say, I don't want to expend the capital, like that's $150. I don't want to expend the capital of buying, $150 worth of Palo Alto networks because my account isn't that large. So how can I continue to take advantage of trading something like Palo Alto networks, taking advantage of these really great patterns that set up? And so one can turn to trading options in a situation like this. And so what I did to do a comparison on trading options, I did a couple of things. One is I did compounding, but and what I discovered was here's what I did. $2,000 trading capital. It did require a little bit higher investment than the $1,000. So $2,000 trading capital would have grown to, in this same year, to over $10,000 by capturing 1/2 of these 5 moves. A little bit over 400% gain if we were trading 65 delta option trade, 65 delta options. And what we were able to do is that value of a delta option. Well, here, I'll show you in this estimation. At this point here, I only had $2,000. I could buy 1 contract. It went up. I took my, half the move. It moved for every dollar it went up, it moved at, it gained 65 cents worth of value. So I'm only taking half the value there. So the dollars I made here were added to the $2,000 starting. But when I got to this point here, I didn't have $4,000, so I could only trade still 1 contract. And so my compounding, while it was good, I wasn't able to double up and trade both the contracts until I got over here. Now my account is up over $4,000. I could basically now trade 2 contracts, and it doubled my profit to increase my value. And that's what went into partly making up this $10,000. And so I was up to 2 contracts. Trade went down. By the time we finished this trade, I was still only able to trade 2 contracts because I didn't quite have $6,000, which was needed to buy 3 contracts. However, when the price worked back up to the moving average, now I had over $6,000 in my account. I could then buy 3 contracts. Therefore, when this return happened, I only captured half of it, but because I was trading a bigger lot size, a bigger number of contracts, I earned 3 times the amount. So that's the compounding. That's one of the beauties of trading options. If you're trading within a plan and you're utilizing appropriate stop losses, but it is a real good way to compound a small account into a large account. But it does have a risk. Option trading is a 2-edged sword. But I just wanted to share that with you to say, there's other ways to trade. Now, could you also trade the index and the sector ETFs in the same way? Yes, you could if you had a small account, but I didn't go back and do the calculations on that. Because what I would like to do is get folks used to buying and selling the individual stocks and our ETFs. Then once the system is learned, apply the system to the option strategy. So anyway, I love the good example, Palo Alto Networks. And what is Palo Alto Networks doing now? Well, any questions? Hey everybody, this is Dennis. I want to thank you very much for listening and watching our video today about how to trade less and profit more, eliminating variables that steal valuable time away from you. Just a real quick highlight. Please join us today as an active trend trader. If you don't want to go and research all this yourself, you can join active trend trading. Here's a discount amount, 40% discount on the monthly rate. You even save any more if you do it quarterly. Please just sign up with us, give us a try for a month, and see if you like us, and see if you don't benefit from being an active trend trader. Thank you.